Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. A lot of negativity this week with downward momentum in the stock markets as interest rates head higher from the Fed. All of a sudden, bonds starting to look a little more attractive than stocks based on one indicator compared to more than 2 decades. Also, market risk very elevated in both the stocks and bond markets, but bond market risk way more worried than stock market participants. And finally, the Fed raised rates by 75 basis points. Expectations for the Fed in the future continue to move higher. Let's talk about why the Fed isn't close to stopping when we take a look at inflation and the Fed funds rate. All right, so on the chart here, we have the percentage of S&P 500 stocks with dividend yields greater than the 2-year U.S. Treasury yield. So two-year U.S. Treasury yield, basically a risk-free two-rate yield. That is up north of 4.2% historically, pretty high, but compared to the past 20 years, that's really good for bonds. Now take a look at stocks. As the dividend yield is simply the dividend divided by the price of a stock, in this case, all of the stocks within the S&P 500. And dividend yields have moved higher because, again, that numerator, the price, has gone lower. We haven't seen dramatic cuts in dividends across the board. So dividend yields are higher, yields are higher, but the yield is winning. Take a look at this. Just north of 10% of S&P 500 stocks have dividend yields that are greater than the 2-year U.S. Treasury yield. Why is that significant? Well, an investor in the marketplace has choices, and all of a sudden they get a risk-free 4.2% versus a stock that has a dividend yield less than that, with potentially the risk that's being offered at this point in the equity market. That's the opposite of what we've seen since the great financial crisis. It's been back to 2006, 2007, ahead of that crisis, the last time we saw it this low, with the Fed pushing rates down near zero for more than a decade. Stocks looked much more attractive than they do now. Now let's take a look at expected bond market risk. So you have the VIX, that's the expected stock market risk there in the orange. It's been increasing, but take a look at it at 30, just north of 30 after the downturn today. That's higher than the 5-year average of 26, but take a look at the MOVE index. That is basically the VIX of the bond market. That's the expected volatility in the treasury market, various maturities. MOVE at 131 has remained elevated during these past several months. That's more than double the 5-year average for that expected risk metric. So bond market investors have been very concerned about the bond market, even more so than stock markets. And historically, we've seen that start to trickle over to the stock market. And finally, the Federal Reserve inflation report came out in August. That spooked a lot of people. It was a little bit higher than expected. We started to see expectations shift for last week's September Fed meeting. It was pretty much priced in for a 75 basis point hike. That's exactly what happened. Some people actually expected, maybe about 1 out of 5 people, in fact, expected perhaps they were going to go 100 basis points. I didn't think that was the case. They stuck with 75. Priced into the market. But what wasn't perhaps priced in is the strong language by Powell afterward, paraphrasing something along the lines of, I wish it would be painless to bring down inflation with interest rates, but unfortunately it's not, all but admitting that they're going to be pushing economic growth lower, causing unemployment to go higher. They believe those short-term consequences are worth getting the job down of bringing down inflation. Market doesn't like it, but it is what it is. Take a look at this relationship. 3.25% is the top range of the Fed funds target rate. Every Fed tightening cycle throughout history, each one of these dates on this chart, the teal is the Fed funds rate when they stopped raising rates, and the orange is the CPI, that's the Consumer Price Index, the price of goods and services in the US, 1-year growth rate at the time they stopped raising rates. What jumps out on this chart is every single time historically they stopped, it was when the Fed funds rate was above. They overshot inflation. Take a look at that. Even at 3.25, with inflation still sitting hot at 8.3%, that relationship's got to change before we start to see a better risk reward market for the capital markets, especially stocks, I believe. Inflation could come down, but it's going to take a little while. And I think while we remain in this environment, caution is prudent. Finally, with football season kicking off for both college and NFL here in the US, little throwback to the thin yellow line. I think something everybody takes for granted, but this didn't come about until 1998, just kind of a blast from the past. Apparently, the yellow line, believe it or not, won an Emmy Award from ESPN when it first came out. Something as simple as marking where the first down line was for NFL teams. Before, you had to kind of look, guess, remember, and now we kind of take it for granted. But it did win an Emmy for that, changed the viewing experience, if you will, for NFL and college football viewers. Maybe we take a little bit for granted, but it did win an Emmy. So congratulations to the yellow line creators. Just a few decades late, but nevertheless, something I think we all still enjoy today. So with that, I want to thank everyone for watching, and I'll see you next time.